Guys, I just poured $1,500 in a new stock. What is that stock? Toll Brothers, ticker symbol TOL. As well as that, I've been eyeing JP Morgan, ticker symbol JPM. Now, why am I eyeing these two stocks during the Rona situation? This is what we're going to get into in this video. Hi guys, it's BK with Let's Become Billionaires, and so today we're going to get into these two stocks, and I know they might sound a little bit boring, but I assure you, there are some things you might want to stick around for and learn about these two stocks that I didn't know myself, and that really blew my mind away. I used to think these stocks were boring as well. But these stocks do have attractive financials and attractive dividend prospects, so these aren't stocks that you want to ignore, and I believe these stocks can easily make you a buttload of money in the near future. So with that being said, let's start off with Toll Brothers stock. Toll Brothers creates luxury homes such as the one on your screen currently, as well as active adult communities with 55-year-olds and older housing, apartment living in luxury apartments in small and medium-sized cities, campus living rentals for students, and city living in major cities like LA, New York City, and Philly. They also operate in 24 states nationwide and have been deemed the #1 luxury home builder. The thing that really shocks me though is their incredibly low valuation. So let's go on Yahoo Finance and look at a couple of things that really shock me in terms of their valuation, and then we're going to talk about in a little bit why I think those valuation metrics make no sense and are way too low, and why this stock should be trading for a much higher price. At the current share price of $29.33, guys, the stock is trading for a P of 8.5. That's it. And the market cap of this company is less than $4 billion. Also, let's not forget about their dividend. Yeah, it's kind of small right now to 1.4% of forward dividends, but the dividend is a payout ratio of around 16%. And guys, what's crazy about this is Toll Brothers is going through the Rona situation. Their earnings aren't optimal. Their earnings aren't where they normally are under normal conditions. And so in reality, this payout ratio could be a lot lower because their profits would in fact be higher under normal conditions, meaning they have a lot more room to grow the dividend than even this 16% payout ratio suggests. Knowing that, guys, let's get into my 4 growth catalysts on why this is a great buy, starting off with catalyst number 1, and that's that Toll Brothers serves a high-end market. If we look at Toll Brothers' average home selling price, we see that in the last quarter, Toll Brothers sold homes for $873,000 on average, and we can see that this makes them a monopoly in their space. They're the only real luxury homemaker, meaning this, guys, there's 2 benefits. 1, they're a monopoly, which obviously comes with its benefits there, but number 2, rich individuals, wealthy individuals, whatever you want to call them, who are buying Toll Brothers homes do not really care about the economy, about the Rona situation right now, because their financials are probably all figured out. They probably have businesses that generate them cash flow. They probably have a big cash savings. And as we'll get into later and find out later through more research, these buyers are fine, guys. Toll Brothers is in a great position, and so the share price being as low as it is, honestly, is redonkulous to me. Speaking of wealthy customers, though, let's look at how wealthy customers are buying Toll Brothers homes. So if we look at the Toll Brothers numbers, we see that, notice, guys, that 19% of homes are paid with all cash payments. And of those who take out loans, the average down payment is 32%. So what you do, guys, is you take the LTV and you subtract that number from 100, and that's your down payment. And so, guys, let's look at this. That is compared to just 16% down for repeated home buyers, according to the National Realtor Association. So what does that mean? So let's come back to the original screen. With an average credit score of 760, keep in mind, guys, the average credit score is around 700 for Americans. With that, guys, we see that Toll Brothers is in a great position because they're dealing with wealthy individuals who clearly have the cash from the data and clearly showing from how consumers buy Toll Brothers homes. Toll Brothers is probably not in that big of a position, and their customers are probably fine and wealthy enough to afford houses in this market anyway. The second amazing thing about Toll Brothers, though, is that they're very diversified in different kinds of real estate and in different kinds of homes. So, guys, up on your screen right now, we see the projects Toll Brothers involves itself in. And as you can see, guys, they're so diversified, they're even building student housing rentals, giving Toll Brothers the ability to thrive no matter what the market is like. If folks want apartments, Toll Brothers has those. If folks want to leave inner cities to move into suburbs, well, Toll Brothers has homes there. If people are starting to retire, which they are because of the baby boomers, well, guess what? They have active adult communities for 55 years old and older. So Toll Brothers is in almost every single real estate market that you need in the high end. And so I'm not really worried about Toll Brothers not being in touch with the current trends of real estate. Guys, catalyst number 3 is something that's really often ignored with this stock for whatever reason, and that's that people are starting to visit their sites again. If we look at the numbers, we see at the end of March, around March 29th, we see a bottom, right? A bottom in terms of site visits. But ever since then, these site visits have only been increasing, and yet the price does not take this into consideration. The fact that Toll Brothers is making a comeback. I think there are 3 reasons for increase in site visits besides the Roni Rona starting to go away. I think number 1 has to do with Roni Rona really showing people that living in a population dense city might not be the best idea for public health reasons. And for that reason, I think some people might be heading out. Another reason is, guys, interest rates are near all-time lows. Actually, they are pretty much at 0, so they are kind of at all-time lows right now. And so I think people might want to take advantage of this, especially the wealthy folks who Toll Brothers targets anyway. But I think the last thing, guys, is there's probably going to be a lot more people moving. And actually, this is something I personally relate to. People don't like their government anymore, including myself. I live in Massachusetts, as all of you guys know. I've said in many videos, I want to move to Texas for just the sake of being free. I'm not free in Massachusetts. The government keeps telling me what to do, tells my family what to do, tells my friends and my neighbors what to do. California's the same way. If we look at Joe Rogan, guys, the man of the most successful podcasts in the world, he has repeatedly said that states that have been using the Roni Rona have been exerting tyrannical control over its people, and he suggested that people move from places like California to somewhere like Texas. He's even said that. But speaking of folks leaving California to go to Texas, let's look at where people are leaving. People are leaving some of these states, I'm going to pop up on your screen, to these states. And what do you know? We see people leaving California and Massachusetts in the Northeast to go down to the South, like Texas, Tennessee, Florida, all of those states. And so there has to be a trend here that's building, and I think the Roni Rona just solidifies that trend even more. So guys, here's what I have to say about Toll Brothers before we get to JP Morgan, okay? Toll Brothers, low valuation, ridiculously low. Payout ratio that's ridiculously low with a fairly attractive dividend for how low the payout ratio is. Room to grow. It's a monopoly in a segment of the population that isn't ever going to have money problems, or at least not really going to have money problems. And guys, people are going to start moving more and more, I believe, as the millennial generation hits that age where they're really going to start buying homes. And so that being said, I think this is a steal. I'm probably going to be buying more throughout this upcoming month. Alright guys, before we get into JP Morgan, please remember to smash that thumbs up button, stash that subscribe button down below, and the notification bell right next to it for a little ding, ding, ding. Because guys, if you enjoy this content, this does help me out a lot, and you can be notified when I put out my next video. That being said, let's transition. Alright guys, now it's time for looking at JP Morgan. Ticker symbol JPM, one of the best and biggest banks in the world. And so let's look at why I think this is a great bank before we get into the numbers and the growth catalyst. Well, the first thing, guys, is that it was one of the only profitable banks during the 08-09 crisis, showing that the management team has dealt with crisis responsibly before. And the other thing, guys, is that JP Morgan has a 3.9% dividend yield in the upcoming year. And guys, its payout ratio, yeah, it's a little bit high at 68%, but let's remember that banks suffered this past quarter. And so in reality, their earnings are probably a little bit higher and their payout ratio might be a little bit lower. That being said, I still think that payout ratio is sustainable, and I do think that their dividend at a 4% almost is probably fine, even if they don't grow it that much for another couple years. All right, folks, now let's look at JP Morgan's valuation. So if we look at JPM, they have a market cap of $282 billion, making it one of the biggest banks in the world. Has a P of just 10.41, which again, guys, would be even lower if it wasn't for the Roni Rona. And it's fairly clear that with the dividend and with the valuation of the stock and being one of the biggest banks in the world, it's at a fairly good valuation. But I don't think I've convinced anybody to buy this stock quite yet. So let's get into a couple of growth catalysts that might shock you and blow your mind. And it did blow my mind when I saw these stats. So let's get into catalyst number 1. Catalyst number 1, guys, is going to be American ignorance. Did he just say that?
Unsubscribe, dislike, leave.
Guys, I'm going to pop up some data from this article. It's a Wall Street Journal article titled Biggest 3 Banks Gobble Up 2.4 trillion in New Deposits Since the Crisis. And holy mackerel, guys, this is an interesting article. By the way, guys, just so you know, the big banks are Bank of America, JP Morgan, and Citigroup. So here's what the article has to say. First thing I'm going to circle on your screen is the 3 biggest banks, including JP Morgan again, which increased their market share by over 50% since the crisis. These big banks, it's their fault. How are they gaining market share? This is why I said it's American consumer ignorance that's making me want to buy this bank. It's the best run big bank, but big banks are somehow winning when they shouldn't be, when they clearly have messed up and failed the consumer. Guys, I think I did a pretty bad job of explaining this part, so let me try again while I'm editing here. What I'm trying to say is that JP Morgan, these big banks, Bank of America, Wells Fargo, Citigroup, they did a terrible job during the 2008-2009 crisis, and they were mostly at fault for what happened there. And for some reason, people are still depositing money with them, even though they know their money's not probably going to be safe with those banks. And so I guess my point here is American ignorance is fueling these banks because people aren't aware that there are better options out there. And so when people say stuff like, and we're going to get into this later as well, but when people say stuff like, oh, online banks are coming, they're going to take away market share, it turns out the data does not show this. So that being said, let's get back to the video. So guys, let's go a little bit more in depth and look at it a little bit more. Guys, the reason I told you in the beginning of this video that these stocks might sound boring is because when people hear of a bank stock, they just think financials. And when people think financials, they think boring. Well, I thought the same thing. And I said, hey, honestly, I don't care for these stocks. And let's be honest, people are going to be moving to online banking anyways. Come to find out, guys, that people who are not financially savvy, which is, I hate to say it, and I really feel bad for saying it, but most people are not financially savvy. So let's look at the percentage of new accounts opened in relation to the percentage of branches that these 3 biggest banks make up. So again, Wall Street Journal, guys, 45% of new bank accounts are going to the top 3 banks despite making up only 24% of branches. This is ridiculous. So guys, this is the market share of the top banks in 2007 versus now. What is going on? I don't know. I don't understand. But guys, what I am going to say is I don't need to understand. As an investor, we have to realize what we're uncomfortable with. I'm uncomfortable knowing that these big banks are taking money from Americans that they do not deserve. But I also see the data, and if I see the data pointing to a stock as a great investment, I'm going to make that investment. So guys, let's keep going though. So big banks have restored a lot of customer satisfaction according to certain surveys, this article by Wall Street Journal says, and have also begun to expand into new markets. So I think that big banks will only get bigger from here. I don't think this is the stop. I don't think this is the end. I don't think it's going to go downhill from here. I think there's more to climb, more market share to gain for these big banks, especially now that they're expanding into new markets that they weren't even in before. And look at the markets they weren't even in. Boston, Philly, Washington, D.C. Are you kidding me? Some of the biggest cities. So guys, now, not only are people going to be wanting these banks for the mere fact that they know their name, but they're going to see these banks, right? I'm in Boston. I don't see JP Morgan anywhere around me. Yeah, I'm sure there probably is a couple, but I don't see them. They're not prevalent in my community. Well, imagine if I was somebody who was just growing up, didn't really know much about banks, but I knew JP Morgan was a big name. I might open up a bank account with JP Morgan and not one of the regional banks around me. Catalyst number 2, guys, is online banking. Now, this is going to be a quick one, but I think a lot of people thought with online banking growing, people going to Ally Bank, people going to all these different kinds of banks with higher interest rates, that folks would go to those banks instead of JP Morgan, Bank of America, Citigroup, Wells Fargo. Well, I think I kind of overthought this one. I think a lot of us did as well, because clearly the data does not show that. And so why does the data not show this? In my humble opinion, I think it's because when you're ignorant and you're an American who doesn't really know much about banking, you don't watch YouTube videos to find out which stocks to buy. What you're going to do is you're going to go with the most reputable name. And usually the most reputable name is going to be a bank with the biggest, most established name. Now, Bank of America is one of them. JP Morgan is another one of them. And so for that exact reason, I think that JP Morgan might actually steal market share even as we shift towards online banking because, guys, people know JP Morgan, people know Bank of America, people know Wells Fargo. They don't necessarily know Ally unless you've gone to one of them YouTube videos that say,
oh my god, get Ally Bank, 3% everywhere.
Guys, so catalyst number 3, during the Rona, a lot of small banks and banks in general realize your loan portfolio is actually very important. Your loan portfolio, guys, if you don't know, is essentially who do you give a loan to, what sectors, what companies. And what a lot of companies, especially small banks, have realized is loaning out to just oil and gas gas companies is a dangerous maneuver. And so if you look at a lot of these smaller banks, you'll see that they loan a lot to oil and gas and energy companies. And what they might do from here on forward is say, yep, nope, not doing that. I'm going to keep some reserves and wait for other sectors to approach me for loans before I give out any more money to oil and gas because I'm already very exposed. And that's probably a smart move. But now a company like JP Morgan, Bank of America, Wells Fargo, Citigroup, all of them can come out and say, hey guys, those small banks that aren't going to loan to you, will loan to you. And the reason they'll do this is simply this. Their loan portfolios are so big that if they loan out another couple $1 billion to a small company, that small company will have its day absolutely made. They'll be blessed, happy that they got a $1 billion loan. JP Morgan, Bank of America, all these companies, they're not really going to be affected that much because as a percentage of their entire portfolio, loan portfolio, not that big of a deal, not that risky of a play, but this can take away customers from small banks and move them over to big banks. I think that's something that people aren't really addressing and people aren't really thinking about. And if you get a good company like JP Morgan who's responsible at investing and they're able to take these companies from smaller banks and responsibly invest in them and give them loans, then JP Morgan can easily increase the loans you're getting and the return on those loans because those loans are deemed as riskier. So guys, in all, JP Morgan has shown resistance to financial collapses in the past. Great management team, one of the only moral good big banks, I mean, relatively speaking at least. And so I really see a lot of potential, especially if their dividend yield and I mean a relatively stable dividend payout ratio. I see a lot going for this company. And I wouldn't be surprised if over the next 10 years, we can easily double, maybe triple our money with a good, safe company that is probably going to make it through this crisis. All right, guys, so the book hanging on the back was Fortitude by Dan Crenshaw. Don't worry, we're not going to get political, but we have a quote for you, ladies and gentlemen, today, and the quote is on page 136. Guys, try hard not to offend and try harder not to be offended. I know this has nothing to do with stocks, but it was something that really stuck out with me during this time of political unrest, so I just want to leave you guys with that. So guys, remember to smash that like button until it's blue, hit the subscribe button, slap that notification bell till it goes ring-a-ding-ding, and guys, be tuned for some more videos, because guys, I make videos like this all the time. I make videos on controversial topics. I make videos for you guys to offer you guys value. So if you appreciate that, please help me out, as it does help me out, and I'll try to help you guys out as well. That being said, please stay safe out there from the Rona. This has been BK with Let's Become Billionaires, and have a great day, folks. Bye-bye.